In this video, I want to talk a little bit about the E-mini S&P, or the overall stock market. And I am actually starting to load up really heavily on short positions. I've already got a bunch of options on, short options on this market, and I want to show you why I'm doing that. I think if we look at this as just a pattern trend, I think it's pretty obvious why I would be loading up on some short positions right now. And so I'm going to show you a little bit of technical analysis. We're going to do a little bit of Fibonacci work on here and just do some counting and some measuring, and why I'm getting a little nervous about this market being way up here at this high level. So the first thing we want to do is we just kind of want to look at the pattern. We'll just draw some simple trend lines in here, and we just use those blue lights from the Bulls and Bears blue light system to kind of help us identify where these trends get drawn in here. But you can see, and it's pretty obvious with hindsight, that these markets were running pretty hard along those trends. And so we have some nice little trend breaks in there. We come in here and draw again this direction here. We have a beautiful little wedge formation. As it came in here, you can see from the bottom to the top. Then it broke out the top, came right back into the center of the wedge, which is something that's very common. And then it bounced and started to rally once again. Now we're up here creating all-time new highs. The market created a new high yesterday, as you can see here, pointed out by the software. And I'm getting a little nervous up in here. If we come in here with our Fibonacci projection tool, and we just project from the low point, that A, B, C, you can see that we're right up in here reaching that 90% level of the Fibonacci projection. Now, as I always tell people, I always say, markets are lazy. They don't always like to do 100% of everything that we expect them to do. Very often, very common, we'll come up and approach that 100%, but it won't quite touch it, and then it'll turn around and drop and fall. I oftentimes have a 90% line drawn in there just for that purpose. If it breaks the 100, it likes to go up and test that 130, and oftentimes we'll go right up into what I call the Fibonacci projection sweet spot between 100 and 130. So it doesn't mean we don't have some additional upside potential. We do have that Fibonacci's projection sweet spot, which is up a little bit higher. But right in here, I'm starting to get nervous. It goes up there and breaks that 100% and goes up in there. I'll start loading up on even more put options. So I've just added a few put options in there right now to take a short position if this market breaks. Now, how far do we expect it to break? Well, we never know how far a market's going to move, right? But we can make our best guess. And what we're going to do is we'll measure using Fibonacci based on how far back we think it's going to go. If we just come in here and measure from the low point here, the C point, up to where it's currently trading, if it just made a 50% retracement back to the Fibonacci sweet spot back in here, you can see that that would be about a $5,800 move here on the E-mini S&P. So that would be a nice little profit to pick up. And if we want to do a Fibonacci projection, time projection, we can even estimate how much time that's going to take. So let's come in here and we'll reverse this Fibonacci tool. And what we're going to do is we're just going to start it right here at the B point, down here to the C, bring it up here to the C point here, which is our new C point, so our A, B, C, and project down. If we're projecting down here into the 76-point level, the 61.8 or the 50% level, that initial first Fibonacci sweet spot, which is between 38.2 and 61.8, if we just come right in there, we can see that we would anticipate seeing that drop happen and occur right around November 16th. So it's currently November 6th. So we got about 10 days we'd anticipate for it to being down into this region, depending on how quickly it dropped. If it kind of does a slow drop like it did over here in September, that's probably what we would see. If it did a fast drop like it did over here in July, well, it might reach that point within a couple of days. If we come back here and look at May 2nd, it did a relatively fast drop again in there, and it would reach that probably much more quickly. So it depends on how fast that market wants to drop, what the nervous nature of the market is, and how much we think that this thing's going to move. Now, notice that we do have the 100% level, which is right down here, and that would be right around November 23rd. So looking maybe possibly around Thanksgiving, having this market be down in this region here. Not because there's anything bad that's happening in the economy or anything like that. There could be something that would come out that would cause this market to break and fall. Usually there's some kind of fundamental news or something that causes the market to break to the downside, but usually it's just profit taking. I mean, the market's been running pretty hard. You can see from A to B, it ran pretty hard before it had some profit taking. Then it ran pretty hard again. We're going to have a little profit taking in there, and then it'll probably take off and start to run once again. I'm not one of these big conspiracy theorists that believes that the market's going to fall to zero. There's a lot of that going on out there, and because of that, over the last 10 years, it has been a constant drumbeat of the market is going to fall and go into nowhere territory, and we're going to all lose all of our money, and the whole economy is going to collapse. That's been going on my entire career, as a market analyst. And you just can't listen to that stuff because it's caused more people than I can count to miss out on the biggest bull run in U.S. history over the last 10 years. And it's all been because of the drum rolls that you constantly hear that the market is too high and it can't go any higher. Whenever a market is too high and you think it can't go any higher, that's when it's going to go higher. When a market is too low and you think it can't go any lower, that's when it's going to go lower. So right here where I'm singing, I'm making that statement, it looks like it's right up in here and it looks like it can't go any higher. Well, we know it can. It's got 100 and it's got 130.9% projection up there, and that market can definitely maybe make a little small retracement. We generally get a little ABC pattern and another rally. There's nothing says this market can't go higher. The economy's doing well. There's no reason why we can't jump on this bandwagon, but we don't want to buy the rallies, right? We don't want to buy into a market that's breaking all-time new highs. We want to wait for that little ABC pattern, the little pullback, wait for it to pull back, start looking for the valley, buy the valley, and sell the rallies. We're in a rally right now, so we're looking for a short position, the counter trend to come back down a little bit. Then we'll start looking to load up, start going long once again. Don't miss out on the biggest bull run of U.S. history because you're listening to that drum roll. But also, be cautious in your trading. Make sure that you're not buying the rally points and selling the valleys. We want to be doing just the opposite. We want to be buying these valleys, buying these pullbacks, and then let that market rally. All right, guys, that is the E-mini S&P.